Welcome to Pro Trader Strategies Market Commentary for Thursday, October the 29th. I'm Eric Wilkinson, and yes, you very well may recognize me as the Wolfman from mainstream media, where I've talked about the economic data, the geopolitical environment, and how that comes in to impact the markets with some of my market analysis. And I do the same thing for you folks out there in these daily market commentaries, but I'm going to go a little bit further for y'all and talk about these option strategies that I'm implementing into my portfolio on any given day to increase my overall portfolio yield. Well, what we've done for you though out there is in webinars created a guideline for you to follow in order to find the right strategy for any given assumption. We aren't just picking option strategies out of the hat. You got a bullish assumption? Yeah, you go out and buy a call. No, it's not that remedial, if you will. What we do is we look at the internals of what's going on around that underlying and then follow this roadmap that I'm going to lay out for you in these webinars to find the right strategies. Sometimes it is buying a call, but sometimes it could be selling a put spread, and things of that nature. So it's not always just black and white. We're going to look at the internals and teach you guys how to follow this roadmap to find the right strategy. All right, so without further ado, let's get on with the economic data. Across the pond, we got some CPI numbers, which was Consumer Price Index. Coming in from Germany at 0.1%, expected to be unchanged, so a little bit better than expected there. But on the flip side, we got Spanish flash CPI, Consumer Price Index. Remember, Spain's not that big of a deal, to be quite honest. Sorry, Spain. But it came in at negative 0.9%, expected to be a negative 0.4%. German unemployment change came in better than expected, negative 35,000, expected to be a negative 5,000, and they revised last month's number up just a little bit. Now, let's move back over here to the United States. One other thing going on over in Europe is the European Economic Summit. We might get some talking heads and some information coming out of there for forward guidance, so something to maybe look at there. All right, here in the United States, we got unemployment claims coming in at 751,000, expected to be 773,000. So a little bit lower than expected, but we've got to keep in mind here, remember, we're going to need to keep our eyes out for the discouraged workers or those people that are falling off of the unemployment claim list and stopping, they aren't continuing to try and claim unemployment. Those are called discouraged workers. Now, they fall completely outside of the statistical data set, because if they're not looking for a job and they haven't found a job, they're considered discouraged workers and they're not a part of this anymore, which is why, remember, we saw the unemployment rate come off quite a bit, is because there was people that were falling off that line. With that being said, one of the main ones we've got here today was advanced GDP prices. So this is one of the inflation gauges that the FOMC is going to be looking at, and it came in, so we'll say GDP advanced, let's say advanced GDP came in at 3.6%, people, 3.6%. It was expected to be 2.9%, so just a huge number, knocking it out of the park. That is something we're going to have to keep an eye on there with price. That's usually showing there's demand for cost of goods. So that drives up prices. More demand, lack of supply drives up prices. That has been a pretty big talking point throughout the day, that the economy is doing rather well. Finally, we got pending home sales. That wasn't so good. Wah, wah. Pending home sales, I'm just going to call it pending home sales, came in at a negative 2.2%. And it was expected to be a positive 3%. So that one, that was a bit of a gut punch there. Pending home sales coming off quite a bit there. Could have been because we've talked about this, seeing interest rates start to rise a little bit. People might have said, you know what, I'm going to kind of hold off a little bit longer and wait for a slightly lower interest rate. So that could be part of it. We are heading into the winter season, which usually starts seeing pending or home sales go down a little bit. But this is a bit out of left field, to be quite honest. Like I said, it was supposed to be a positive 3.1%. Also, finally, natural gas storage is coming in at 29 billion cubic feet, expected to be 35 billion cubic feet. All right, so one good number, one pretty bad number, to be honest there. All right. Crude oil coming off, breaking below that 200-day simple moving average yesterday, settled below there. I talked about that. We probably were going to go down there and test that number. That was going to act as support, but it peeled right through it. Now that we're through it, you can see today moving down to that $33 a barrel mark. Not quite hitting there just yet, but it's going to take a lot to keep this market afloat or buoyant, if you will, without going down there and testing that $33 a barrel, especially with what we're seeing here with the resurgence of Corona. That's going to possibly start shutting down more places than just Germany. Other people are going to be continuing to look at closing down different aspects of the economy. Again, it looks like, and with no stimulus, this could be very bad for the United States for sure, but a global economy as well. All right, so crude coming off, making it cheaper at the pump for the rest of us, but we see gold here coming back off, and after yesterday's big sell-off, we got below 1900. It's below that even further now today, off by about another $10. But a thing to note, you know, there's no real line in the sand here that we have, other than it kind of lines up with the value area, but something to keep an eye on here is about this line right here. Whoa, I thought I was getting a straight line there. Sorry. Let me erase that. I wanted to get a straight line here, so we'll throw it there. So basically, it looks like it's lining up right around there. 1850 is about that. Only because we've came down there and bounced in and around it a couple of times is why I'm really keeping an eye on that. It doesn't really line up with any of my Fibonacci's, although they're a little bit wanky because we have our 100%, which is the old high from back in the Great Recession area. So that being said, I want to keep that in mind because that is something that most people will be keeping an eye on there. And it lines up very well with everything else. So that is something we'll have to keep an eye on if we can hold on to that 1850 area moving forward in gold if you are a gold bull. All right, so bonds, they are coming off again today. We are still seeing this lower lows, lower highs. You can see we got lower highs, lower lows. I mean, it is basically wanting, and we could do it again there as well. Basically, as a matter of fact, go like that. Just the whole thing is just really wanting to trend to the downside here and just really struggling to get back above and make a newer high there. And we usually talk about this. I didn't think it was going to happen here, but we get the correction. You get 1, 2, 3. That's really 3, 4, and 5 before you would start moving up there. So it kind of is setting up like that, where it's making that 5 wave to the downside before it's able to resume up. I don't see it happening, people. I just think that the Fed is going to come in, especially if we don't get any type of stimulus, which is needed more so than the Fed coming in and supporting bonds and lowering interest rates synthetically or quantitative easing and things of that nature, because that really goes to the bigger businesses. It doesn't even help out the small businessmen at all. It will help out for the retailer in the form of being able to have a lower interest rate for their homes. But you can see the bonds really starting to make a move to the downside, and I just think it's overdone to the downside. I haven't added anything because I'm kind of waiting for the chart patterns to set up in there to make a move, and it hasn't really. VIX is coming off a little bit today. We've got the markets trying to claw back some of yesterday's losses. As you can see, yesterday, though, it was pretty ugly. We talked about it, and it accelerated into the close. But today, we came down in the Dow Jones Industrial Average and tested the 200-day simple moving average. So we got the 200-day simple moving averages in that orange. Maybe I should have done that in orange there, but you can see, came down and tested that. Now, it is my belief that the market is correcting here. I don't think we're going to see much more. We are about, I think it's right around 10% correction from those highs there. So, you know, that is a healthy move to the downside, kind of flushes out the weak hands, and now we start moving back to the upside. Now, if we break below this 200-day simple moving average, we're going to have to be looking at this 61 Fibonacci, which lines up right around that 25,200 area. All right, so then we've got the Nasdaq making a bigger move. And now remember, it was actually pretty much lagging to the downside as the broader markets were selling off, and now it's accelerating to the upside a little bit better than the rest, up 175 points right now on the day. Now, with yesterday's market movement, I wasn't too sure we weren't going to go down here and test this value area high today, which is what it was really looking like. But that 11,000 mark has been allowing people to, or where it was really being defended. As we started going down there, you could see the momentum really starting to slow off. And then we move over to the E-mini S&Ps. Again, finding support on some of these key levels here. This one was the 3253 area. You can see we tested that yesterday, tested it again today. Now, I've also said that when you have the point of control, we've got a point of control lining up right here. We've got the point of control lining up with one of our Fibonacci's. Now, usually we would see that not act as much of a support and resistance because that point of control is going to kind of overpower it a little bit and act as a magnet to pull it through. But it is holding on. As you can see today, that 3253 is holding on. Something to note here, anytime we've got chart pattern setups where we've got this bearish move to the downside, a real red pattern. Now, the key one is that green one right there. Green pattern is usually a continuation pattern. So when you get a big red candle and then the next day you get like a green candle where it's kind of like that, that usually signals we are going to continue to the downside. All right. So, you know, I don't know how to say that this would probably set up for more of a bullish signal other than if we got the chart pattern set up where we've got the big red candle and then today we peel down and maybe get down to around that point. So then the candle would kind of look like this. All right, so that would be more of a feeling like the market has kind of bottomed out here and is looking to resume to the upside. Of course, we would have to have confirmation of that with a green candle kind of like that. But those are the two scenarios we'd be looking at. So probably if you are bullish and trying to read the tea leaves, one of the ways we'd be wanting to see something like this is finish near those lows of the day or at the lows of the day, what we're seeing here now, and kind of set up like that chart pattern that I've seen or showed you. All right, so anyway, moving on to the E-mini S&Ps inside day after yesterday's big sell-off. A bit surprising too. Overnight, we did have the big sell-off there. Then during the day session, it did calm down. So our points of control and our value areas are pretty easily distinguishable here with the market, and you can see we've got our value area high, value area low inside of yesterday's value area high and low, and the points of control lining up quite nicely there, to be honest. And market's really being quiet today, really waiting on some more information really out of these earnings. Remember, now tonight is the big night. We've got Apple, so we're going to have Apple, Amazon, I think Apple, Amazon, right? Amazon, Apple, yep. And Google, all right? Google is coming out after the close. So some big, so the big dogs are coming out today. So this is for earnings. Keep that in mind. Earnings, Amazon, Apple, and Google today after the close. So I'm going to be looking at playing some of those. I've been holding out on some of my margin and my money in my pocket just to keep that in mind. I didn't play these trades yesterday. There was Yum and a few other ones. I didn't play those, you guys. Why? Because I just wasn't feeling real real good about the overall markets yesterday. You know, I've been wanting to play these to the downside, although I'm pretty bullish on Yum Brands and some of these fast food restaurants, as you've heard me talk about over these webinars or these daily market commentaries, that I think that fast food is kind of what is going to start accelerating through this pandemic. People want to go out and get something out. Well, a lot of places aren't allowing you, like in Chicago, to go and sit inside of a restaurant. So what's everybody doing? They're going through the drive-through, right? Well, Yum Brands is going to do very well through that type of scenario. All right, Ford. Now, I didn't do anything with Ford because you guys remember my long-term portfolio and my IRA, and just as a long-term holding, I played or I have Ford in those accounts. So I just left this on. I didn't do any covered calls or anything else or sell any puts on it. But something to note here is they knocked it out of the park, although we are selling off quite a bit, up almost 10% overnight. But the F-150, which is the highest margin vehicle here in the United States and in basically the Americas. It is the highest profit margin truck or vehicle for that matter. And they said sales of that are going gangbusters with the Ford Raptor and everything else, which is an F-150. So they're doing very well and came out with great forward guidance, everything else. Market's kind of beating up on them right now. Now, Coca-Cola, you guys remember I have this also in my account. And what I've done here is look to continue to lower my overall cost basis on a trade like this, where it is going down. So I decided to go in there and sell some puts in there, maybe possibly do some dollar cost averaging. So I went in and sold the November. I sold the November 44 puts. I think it was the 44 puts. Yes, the November 44 puts for 40 cents. So for Coca-Cola, I'm trying to do some dollar cost averaging and went into the November. Sold these are the November that expire, you know, in 20 some odd days. They expire on the 20th of November. So sold the November 44 puts in there for 40 cents. All right, lowering overall cost basis on this trade or dollar cost average. You know, it's all kind of one and the same. So collecting 44 cents in Coca-Cola. And if it goes down there to 44, which is great strike location, value area low. You know, we've got that same chart set up there, as you can see, where that could be either a continuation pattern to the downside. It looks like it might go down there, so I'm going to take that opportunity to possibly do some dollar cost averaging. Something to note here, though, you can see as well that there is a pretty good support line without drawing any type of other chart pattern with that value area low. So I would love to get put the stock at 44, find that support, start getting a bit of a rebound there after my overall dollar cost averaging. It's probably the point of control is where we're looking at for my point of control right there is going to be right around where my break even is for this trade. All right. And finally, I think I've got one more chart to look at. No, I don't. The thing that I will be looking at, like I said, is Amazon. Apple, I think Apple is one of the few ones that's doing very well today ahead of their earnings. Apple, as you can see, they're beating the broader market to the upside. And then we have Google also coming out after the close. So all of those I will be looking to play most likely to the upside. Although, you know, these are the tech sectors, and I think that they've done well throughout all of this. So I'm going to stick with these to be to the upside. And if I get put these, like I said, I'm going to be playing relatively small. But if I can put these stock, then I'm going to be happy to own these over the long term, especially if we're going to be a stay-at-home economy, because Amazon, Apple, and Google are going to do the best through all of that. All right, so that's all I've got for you guys, other than we got to do the one last thing here, and that is talk about our disclaimer. So please take a moment to go over this, as we are an educational company, and you need to know your risk before getting involved here. All right, so that's it. That's all I got for you guys. Check out today's webinar. It is going to be on the short iron condor. So make sure you follow that one. It's one of the favorites, right? As if we don't know what direction it's going to go in, or we have a sideways directional move, when is the best place to implement this strategy? All right. Or when would we find this strategy, the best strategy to implement around our assumption, which is what we're trying to do for y'all. All right. So if you can't take that, take it easy.